Hello and welcome, options traders. Well, is time decay a risk? It's a great question, and I hear this a lot from new traders. And if you ask virtually everyone out there, is an options time decay a risk? They'll say, of course it is. A portion of that options price is bleeding away with the passage of each day. So if that stock doesn't get up and moving quickly in my favor, I'm losing money. Losing money means risk, so of course it's a risk. Not so fast. It depends on where that options price is losing value. Where is it coming from? And you're going to find out that there are really two main sources. One is a true time decay, but it's not a risk. And the other appears to be time decay, but it's from a different source. It's not really time decay. And that's why it can become very confusing for new traders. So for instance, there are really two sources where you can end up with your prices going against you. One is from time decay, which is from the passage of time. This is what we would call the traditional time decay. Time is ticking away and we're losing a little bit of that options value. But there's another thing that's really more of an apparent time decay, and that comes from decreasing volatility. And so when options traders are setting up their strategies, if you're not accounting for where these risks could be coming from, you can end up with very unwanted surprises. So let's take a look at each of these in depth. So let's start with traditional time decay. And again, this just means that an options value slowly decays over time. All things being equal, stock price stays the same, volatility is the same. We're just letting time tick off the clock. Yeah, a portion of an options value is going to bleed away. And so again, this is what we call time decay in the truest sense of the word. But you also have to understand that only the extrinsic value, or also called the time value, is what's susceptible to time decay, not the intrinsic value. So for example, let's say that our stock is trading for $100 and we're looking at the $95 call and it's trading for $7. Well, of this $7, we can break it down into intrinsic and extrinsic values. So here, $5 is called intrinsic value. And that's because with the $95 call, we have the right to pay $95 when the stock is actually trading for $100. So technically, I could buy this call, exercise it, buy the stock for $95, turn right around and sell it for $100, and put $5 in my pocket. That's an obvious immediate benefit. I can pull that $5 out instantly. So of course we got to pay for that. That's the intrinsic value. It has nothing to do with the option. The option is what we pay over and above this. So because the option is trading for $7, that additional $2 is what we call the extrinsic value or the time value. And it's this portion right here that's going to get hit from time decay. And so in this example, what do we know? We know if the stock is still trading at 100 at expiration, the extrinsic value here is absolutely going to zero. That's just a mathematical fact. All extrinsic values become zero at expiration. But notice the intrinsic value didn't get hit. It's still $5. So sometimes new traders think, oh, well, at expiration, this option is going to be worth zero. Not true. The extrinsic value is worth zero. But here, the option would be trading for 5 from 7. So it would have lost $2 of that 7, or about 28%, not 100%. So the thing that I want you to understand right now is that it's only the extrinsic value that gets affected from the passage of time. So this price sensitivity of an option is actually measured by one of our Greek sensitivity measures called Theta. And if you're not familiar with your Greeks, or specifically Theta, I do have other videos in here that will explain that. But in this example, we had the $95 call trading for 7, and let's say that our broker's platform says that the Theta is 0.05. You can just look at right up there on your broker's platform, shows 0.05. What does that mean? It means that if all things stay the same, stock price, volatility, everything stays the same, but 1 day's time passes, this option is going to lose Theta, or 5 cents. So we would expect that tomorrow that this $95 call will be trading for $6.95. Now again, that's all things being equal. If the stock price takes a big hit or a big jump up or volatility changes, all bets are off. This is just measuring the sensitivity to 1 day's passage of time. So again, this is what we call a traditional time decay. And so if you ask most traders, they'll say, yes, of course, theta is a big risk of an option. Well, but think about it. Risk is associated with uncertainty, and time moves in one direction at a constant speed. We know it. It shouldn't be a big surprise that in 7 days from now, 7 days are going to pass. And so why should we consider that a risk? So professional traders usually say that time decay is considered a characteristic of an option rather than a risk. We know it. We expect it. It's really a cost of doing business. So it shouldn't be a surprise. And if you have that mindset, it's going to help you with your strategies rather than thinking, oh, I can't bear to lose, these $2 of time value here and I need to get out. We knew that that was going to zero. However, there's another factor that can affect an option's value, and that is Vega. And so Vega shows an option sensitivity to changes in volatility. So let's take a look at a different example. Let's say that we have a $100 call trading for 5 with the stock at 100. It's an at-the-money option. And volatility is 20%. And we look at our broker's platform and it says that Vega is 0.10. And what this means is that if volatility ticks up or down by 1 tick to 21, or if it decreases to 19, that option's price is going to change by 10 cents. It'll increase if volatility rises and it'll decrease if volatility falls. So let's say that volatility drops to 19%. What's that option worth now? Well, we would expect that $100 call to trade for about $4.90. And again, that's because of this value right here, our Vega. But the thing that you must understand about Vega, unlike Theta, is that Vega is based on perceptions. It's based on what people think is going to happen in the future. And as I've talked about in many videos, remember that the market doesn't care what you think. The market's going to do what the market's going to do. But of course, option prices are giving us some insights into what people think. So here's where people can get trapped into thinking that they had a huge theta risk that was really Vega. Let's say we have an option with 14 days to expiration. Our stock is 100. We've got the $100 call trading for 5. So again, it's an at-the-money option. There's 0 intrinsic value, and all of this option's price is extrinsic value. So tomorrow, we might look at our platform and say, I would expect this option to be trading for $4.95. Maybe it's got a theta of 0.05. And yet tomorrow we get up and we find that the option is trading for 50 cents. And you're going, oh, I got killed by time decay. I mean, look at this. Only 1 day's time ticked off. It had 14 days to expiration yesterday. Now it's got 13, and yet it lost almost all of its value. So it was a huge risk to me. That is not time decay. That is from volatility. And in options trading, when it's this severe, we call it the volatility crush. And in almost all cases, this is due to earnings or with FDA announcements, which is something you can expect to see with a lot of the coronavirus vaccines that are expected to come out. And so what can happen is that people will say, oh, I want to pay $5 or $10 for this option because I think earnings are going to be amazing tomorrow. This $100 stock is going to be trading for $110 or $120. So yeah, they might pay $5 or $8 or $10 for this option today. But once the news is released and we see that the stock's price is still the same, they say, you know what? Now the answer's known. It's not an uncertain thing anymore. We know how the market's going to react to the news. So yes, yesterday I might have been willing to pay $5 for this option. Market says today, I'm willing to pay 50 cents. So again, that is not theta, that is from Vega. But it can give the appearance of time decay. So when you're talking about price risk, how should you consider it? Well, first of all, remember that time decay, as measured by theta, is the true time decay. It's measuring the tick of the clock and its effect on that option's price. But that's not really a risk, it's a characteristic. We know it's going to happen and at what rate. But we can also have price risk from volatility as measured by Vega. And that's one that can change on a dime for better or for worse. But in both cases, whether you're talking about theta or vega, always remember that your intrinsic value isn't exposed to either of these. The extrinsic value, however, is 100% susceptible. But the main thing is to understand that when you're setting up your strategies, you must consider both time decay and volatility. And depending on the risks that you're willing to take and what your outlook is, it will determine the strategies. Because if you're setting up your strategies without theta and vega in mind, you can end up with some very unwanted surprises. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.